As many traders know, spotting a valid order block is just the beginning. The real test lies in grasping why price doesn't always return to those zones, and more crucially, how to turn that into an advantage. In this episode, we'll dive deep into the order flow concept and build a complete trading strategy with a refined entry model. If you've been frustrated by missed opportunities because your chosen order block failed to get mitigated, then this video is tailored for you. By the end, you'll clearly understand order flow and have a reliable trading plan that enhances your decision-making and improves your overall profitability. So traders, if that's something you're looking for, make sure to hit the like button to show your support, and subscribe to our channel if you're joining us for the first time. See you right after the intro and disclaimer. Welcome back, traders. Let's jump right into it. Many traders often ask why a well-marked order block on the chart doesn't get mitigated, even though the price still moves in the predicted direction. The key to answering this lies in understanding order flow. While order blocks offer important clues, they don't always dictate how price behaves. Other factors like overall market sentiment, macroeconomic events, and the dynamics of supply and demand also play a vital role in influencing price action. Be sure to stick around until the end of this video, as we'll thoroughly explain the concept of order flow. Along with that, we'll construct a trading strategy and walk you through an improved entry technique that utilizes order flow for better precision. This will give you useful insights and actionable steps to enhance your trading method. So, what exactly is order flow? In trading terms, order flow highlights zones of strong supply or demand, where trading volume surges with a high concentration of buy and sell orders. It also encompasses the concept of the order block, a particular price point where heavy buying or selling occurred in the past. By studying order flow, traders gain clarity on likely market direction and can pinpoint crucial supply and demand levels. Now, let's explore how to spot order flow within the market. Essentially, order flow marks areas where buying or selling momentum builds up before a breakout or a structural shift in the market. Bearish order flow refers to a chart region containing a sequence of bullish candles, usually two or more, that forms just before a sharp and aggressive bearish move to the downside. In contrast, bullish flow marks the area with bearish candles that occur right before a sudden or strong bullish price surge upward. By treating order flow zones as key areas of interest, traders can uncover potential entry and exit levels. For instance, the previously mentioned bearish order flow zone may serve as a suitable entry for a short position, as it signals strong market selling pressure. Let's break down order flow using a downtrend scenario. In this example, the price initially forms a low and then rises, collecting liquidity above that structure. Then, without warning, price drops significantly and breaks the earlier structure. This zone, where liquidity was collected before the sudden fall, is what we call the order flow zone. It reflects the final burst of buying pressure before price drives downward and breaks the prior low. It's critical to understand that an order flow zone includes a minimum of 2 candles. We are not referring to a single candle setup here. Inside this order flow zone, there's also an order block linked to the boss, break of structure, movement. As shown, an order block is simply a more refined part of the broader order flow zone. Many traders often question why the market doesn't react to an order block, even when it aligns with their setup. One key explanation is that price doesn't always mitigate the order block, and the reason lies in order flow itself. Most order blocks sit at the very edge of an order flow zone, and price can reverse direction before ever touching the block. That's why it's important to treat order blocks as just one part of the overall order flow structure, not as a standalone decision-making tool. Let's go further. In this scenario, price pulls back to the inducement zone, pauses slightly, and then quickly reverses upward, triggering stop losses of traders who entered short at the inducement. After grabbing this liquidity, price continues climbing until it returns to the previous order flow zone. At this stage, price shifts direction back downward and resumes its original bearish trend. Again, we're looking at an order flow zone, this one representing the final buying activity before the next downward boss. At the far end of the zone, we find an order block. This reinforces the idea that price tends to respond more reliably to the entire order flow zone rather than just the block itself. That said, order blocks still play an important role. They help fine-tune your entries within the larger order flow zone. Using this method, traders can minimize stop-loss size while targeting higher reward-to-risk setups, a core principle for long-term trading success. As you can see, identifying these order flow zones is fairly straightforward, but before we proceed further, let's take a moment to briefly cover the idea of inducement areas. We've already discussed this topic in greater detail in a dedicated video on our YouTube channel. For now, here's a simplified explanation of inducement areas. In this particular example, we observe that price initially touches the upper order flow zone and then moves downward without breaking the most recent structure. Afterward, there's a minor upward retracement, followed by a bearish move that leads to a structural break. At this point, we can identify an unmitigated order flow zone, which could potentially trigger a reversal. There's also another untouched zone near the break of structure, which often leads to confusion among traders about which zone to focus on. As covered in earlier videos, inducement zones are typically engineered by large market players such as institutions or central banks. These zones are designed to mislead retail traders into premature entries, either buying or selling, and in doing so, they help generate more liquidity for the smart money participants. Being able to recognize these zones and their influence is critical for making sound trading decisions. For a more in-depth look at inducement zones, don't forget to check out our exclusive video on the channel. In our case, the order flow seen here represents a classic inducement level. Price appeared to make an attempt to mitigate the upper order flow, but instead it quickly dropped and broke the nearby structure to the downside. This movement created what looks like a false order flow and a misleading order block. Why do we call this an inducement level? Because price behavior was manipulated in a way that lured traders into false positions, thus generating liquidity for institutional traders like central banks and major financial entities. Now, let's take a quick look at the structure of a bullish order flow. In this scenario, we observe that the market is trending upwards, forming a series of higher highs and higher lows. A break of structure occurs as price surpasses the previous high. This identifies a zone that marks the final bearish momentum before price moved higher and broke structure, confirming the bullish trend. That gives us a clear order flow zone. At this point, we notice an order block situated within that region. However, price doesn't react to the order block. Instead, it responds to the broader order flow zone and moves upward. As a trader, you might anticipate that price will retrace back to the order block to provide a long entry opportunity. But this mindset can lead to missed trades, as the price may continue climbing without returning to the block. Relying on a retracement to the order block can delay your execution, causing you to overlook other valuable setups that form in the meantime. Moving forward, we witness another break of structure. This time, there's an order block sitting at the edge of the bullish order flow zone. After price touches the order flow area, it immediately pivots upward and resumes its bullish move. Had we placed a buy limit at the order block itself, the entry would have remained unfilled, and we would have missed the entire upward swing. Waiting for price to revisit the order block would have meant missing a clear bullish opportunity. Before jumping into live charts to identify order flow zones, there's an important reminder for every trader: backtesting. Testing your strategy thoroughly before using it on a live account is essential. We strongly advise testing any strategy a minimum of 100 times. This is because win rates are affected by multiple elements: market conditions, psychological discipline, session timing, risk strategy, and the time frame you're working with. Now, let's move over to the charts and explore some actual examples of order flow, so we can learn how to identify them effectively in the market. We now have the Euro-Dollar 1-hour chart displayed on screen. It's important to mention that order flows can be spotted on any time frame. Their identification is not limited to a specific chart interval. If you're analyzing order flows on a higher time frame, you can always shift to a lower one to fine-tune your entries. Looking at the top left section of the chart, we can observe a break of structure. As discussed earlier, a bearish order flow highlights a zone on the chart made up of bullish candles formed right before a strong bearish move. This zone marks the final area where buying pressure was evident before price dropped aggressively. This area typically represents where buyers entered prior to the decline, creating a potential resistance zone that price must overcome if it intends to continue falling. Now, moving slightly lower on the chart, we spot another bearish order flow zone that formed close to the previous boss. As mentioned before, this order flow is likely an inducement area created by major institutions, such as banks, to mislead retail traders into taking short positions, which in turn increases available liquidity for them. Despite this, price did not respond to the order flow zone. Instead, it moved downward, triggering stop losses for traders who had entered short positions within that area. Zooming in on the order block tied to this boss, it's evident that price dropped sharply without ever retracing to mitigate that block. Still, many traders were expecting price to come back up to the bearish order block for a short entry, but price reversed from the broader order flow zone without touching the block. This demonstrates that price doesn't always need to revisit the order block before continuing in the opposite direction. A similar event occurred at this next point. The market printed another break of structure. The final bullish movement prior to this boss formed a new order flow zone. Upon reaching this zone, price shifted direction again and moved lower. Here we see another boss, and the zone containing the last sequence of bullish candles before the drop has been identified and marked as a new order flow. Once again, we observe a break of structure. This newly highlighted zone marks the final buying momentum prior to a sharp move downward. Thus, we classify it as another order flow zone. If we examine this order block closely, it becomes clear that after mitigating both the order flow and the order block, price reversed and moved further to the downside. Another boss follows on the chart, and the corresponding order flow is easy to spot. We can also mark a nearby order block and a second order flow slightly lower. However, in this case, price didn't respect the second order flow, it acted instead as an inducement. This was likely because a more extreme, unmitigated order flow existed just above it. Price was likely aiming to grab the liquidity resting above that level before continuing. At this stage, we've developed a strong ability to identify order flows on the chart with confidence. In the next section, we'll explore how to apply the order flow concept to build a profitable trading strategy and execute trades with precision. Assume that price has developed a bullish structure pushing upward, as illustrated in this example. By closely analyzing this move, we can clearly pinpoint the order flow zones formed within the trend. Our strategy here is to wait until price approaches the extreme order flow zone visible on the higher time frame. Once price taps into that region, we shift to a lower time frame to observe a significant change of character in the price action. After confirming a valid CHOCH, change of character, we then mark the order block created by the wave that produced the CHOCH on the lower time frame. At this point, we can position a buy order at the highest level inside the identified order block zone. To manage risk properly, our stop loss should be placed a few pips beneath the lowest point of the same zone. As for the take profit target, we can aim for either the nearest unmitigated supply zone or simply the most recent swing high. By using this approach, we aim to ride the bullish order flow while optimizing returns and keeping our risk exposure controlled. Now let's take a look at a live example on the chart. We're now looking at the EUR1 United States dollar hour chart, where the following price action is observed. Initially, price broke below the recent structure, made a temporary upward move, and then reversed after tapping into the bearish order flow zone. It's worth noting that the sell orders aligned with the corresponding order block, which smart money concept traders would typically use, were not triggered in this instance. Following that, the market dropped sharply, printing another break of structure with 3 consecutive red candles, while also leaving behind a noticeable inefficiency. At this stage, our priority is to identify the bearish order flow that developed during this downside movement. This specific zone marks the last presence of bullish momentum before the aggressive move downward. Once we've marked this area of interest, the next step is to patiently wait for price to revisit the order flow zone. As shown on the chart, price makes a strong upward push into the zone, marked by a solid white candle. From here, we shift to the 1-minute time frame to gain a more detailed view and look for a significant change of character, CHOCH, in the price action. Now we're looking at the 1-minute time frame chart. As you can see, price formed a significant change of character by breaking this structure and also left behind a notable inefficiency. In the next step, I'll highlight the order block created by the wave that caused the CHOCH. With our area of interest now clearly identified, we move on to placing a sell limit order at this level. We'll adjust our stop loss just a few pips above the highest point of the zone, and for our take profit target, we'll aim for this swing low, the area where we anticipate price will likely head. Our sell limit has been triggered, and we're officially in the trade. Now it's just a matter of letting the market play out. As expected, once the entry was activated, price began to fall and eventually reached our take profit level. By applying the order flow concept and sticking to a structured trading plan, we managed to enter at a strategic point and secure a winning trade. This clearly shows how effective order flow analysis can be when integrated into a trading system. Keep in mind, trading isn't only about making gains. It also involves managing risk and maintaining discipline. Success in trading doesn't happen overnight. It requires patience, practice, and constant learning. So don't be disheartened by setbacks, and always work on improving your skills. Great job staying committed, and I wish you the very best on your trading journey. Thanks for tuning into this video. I hope you found this video insightful and helpful. If you haven't already, make sure to subscribe and turn on the notification bell so you never miss any of our future uploads. We'd love to hear your thoughts and ideas. Drop a comment below and let us know which topics you'd like us to explore next. Thanks for your continued support, and we'll catch you in the next episode.